Good evening. This is Shyam. I'm from Delphi Education, and with me we have Viva Modi and Mr. Pranav Modi. We all are chartered accountants, and Pranav and Viva are specialists in corporate tax. Recently, she has done a wonderful batch for the corporate tax, just finished, and she's keep on updating about the corporate tax in the form of webinar. Okay, and she's excellent about the corporate tax, the implications about corporate tax in free zones, transfer pricing, and your compliance under corporate tax. And today again, after latest updation, she came with lot of more information about the corporate tax as applicable to UAE. So I welcome to Viva. Please give your views and latest updation about the corporate tax. Thank you. Welcome.
Thank you, Shyamji, for a nice introduction, and welcome all once again. I think this is our fifth webinar which we are doing with Delphi, and Delphi is always welcoming to do combined webinar, and we come up with the latest updates in this new corporate tax, and then the VAT updates also we are keeping updating in our webinars. So this webinar is specifically dedicated on the recent law issued by the FTA on corporate tax, and I will like to mention here before starting the webinar that this is a gist of or I will say 30 to 40% information is there in the law which is required for the implementation of the corporate tax. Still there are many procedures, tax procedures and cabinet decisions are awaiting from FTA side, which helps us to implement it fully. And in the law itself, they have mentioned in various places and giving references to the cabinet decisions and procedures. So we are awaiting more updates from their side. But yeah, they give the more clarity in comparison to the previous consultation document. So I hope I'm going to cover major updates which they have given in this decree law. So we'll start with the rate of tax first of all. These are the things which we are going to cover today. Rate of tax, what is the taxable person, what are the bases of charging corporate tax. When we are talking about the taxable person, there are the concepts of permanent establishment and income sourced from UAE. Exemptions they have provided the exemption in consultation document also, and here they have given the more clarity on that part. The most important part is free zone. They have given the clarity on that part, that which income is going to taxable in free zone, but still that there is a lot of gray area in free zone. We are awaiting more information on that. On expenses side, they have given that what are the non-deductible expenses, what will be the allowability of interest, expenditure, tax losses, tax groups, what will be the provision of withholding tax. So these are the major topics which we are going to discuss today. We'll start with the rate of tax. So they have defined in this decree law two rates. One is 0% and another is 9%. In the consultation document, they have come up with a 15% rate of tax also, which is majorly for pillar 2 companies as per BEPS, but they have not mentioned anything about the same in this decree law. They have only specified two rates, one is 0% and another is 9%. So they have mentioned that whatever the limit specified in the cabinet decision, if the taxable income is less than that, then it will be taxable at 0%. So as per the consultation document, the limit is $100,000, which is 375 dirham. But they have not mentioned that limit again in this law. They have mentioned that it will be in the cabinet decision. So to get the clarity on the basic exemption, I will say, though there are very minor changes, that there will be the change in the basic exemption limit from 375,000. But still, I will like to clarify that they have not mentioned that in this decree law. So whatever the basic limit they will specify in the cabinet decision, If the income is less than that, that will be taxable at 0%. Then they have mentioned that whatever the qualifying income, they come up with a new terminology, which is a qualifying income. Under the qualifying free zone, that is also going to be charged again 0%. So the qualifying, what will be the qualifying income? Then again, they will saying that they will clarify that in cabinet decision. But it is majorly, we are expecting it is majorly if you are dealing only within free zone and outside UAE from free zone, that will be the qualifying income. If you are dealing with mainland, that will not be a qualifying income. But the clarity on the same is not there. Then if that income is happening under the qualifying free zone, then it will be taxable at 0%. So what will be the qualifying free zone? They have mentioned that thing. I will explain that in the later slides. Other than these incomes, the limit specified and the qualifying income under the qualifying free zone, all the income is taxable at the rate of 9%. As per the consultation document in the decree law, they have not mentioned the rate also. So I think those changes will not be there because they have come up with the framework. So it is going to be the 9% majorly. Then the most important question is who is going to cover under the UAE corporate tax. So I have divided the type of taxable person. There are only going to be two types of taxable person. One is resident and another is non-resident person. So all the people cover under person cover under the resident and non-residents are going to be the taxable person. And taxable person means they are liable to pay corporate tax in UAE. So let's start with the resident person. So any judicial person incorporated in UAE, including free zones, is considered as a free zone. So whoever is a license holder in mainland or in free zone, even in offshore, is considered as a resident person. Any person effectively managed and controlled in the state. So if the management and the control of the, if I'm referring to the person, that means a legal person or a natural person, legal person who is a registered person in UAE, if they are managed and controlled in the state, then it is also considered as a resident person, even they are not registered in UAE. If anyone, any foreign company which is not established in UAE, but they are effectively managed and controlled in the state, the management is here, the decisions of the company is taking from the UAE, then it is considered as a resident person. So why we are going through a resident person and non-resident person? Because the law for both and the income, taxable income for both is different in their hands. So some incomes are, all the incomes are taxable in the hands of resident person, which they are earning either from the UAE or outside UAE. And for non-resident, the outside UAE income is not taxable, only UAE income is taxable. So that's why it's very important to know that who are considered as a resident person and who is considered as a non-resident person. Then third is the resident person, any natural person who conducts a business in UAE. So as we know, this is a corporate tax, this is not a income tax. So the difference between corporate tax and income tax is this, that corporate tax is only on corporates. It is not on personal income. It is not an income tax. Income tax is on all the incomes. So generally the concept of this corporate tax is in UAE is that it is going to apply on businesses, not on salary of an individual person. But if individual person is involved in any activity which requires licensing, then it is deemed to be assumed that that is a business of a natural person, and the natural person will also cover under the purview of corporate tax. So these are the definitions of resident person. Then what is a non-resident person? If anyone is not having a company in UAE, but they have a permanent establishment in UAE, they are also considered as a taxable person in UAE. They are liable to pay tax. What is the permanent establishment? We will take the snapshot of the same in the upcoming slides. If any income is generated from UAE, that is also considered as a that income is taxable under corporate tax, and that is considered as a non-resident person. If there is any nexus in the state here I'm referring to UAE, if there is any nexus in the state, then also they are covered under a non-resident person and covered for liable for corporate tax. Then if there is a branch, they have clarified that thing also, that if they have a company, one company is one emirate, and the another company branch is in the same emirate or a different emirate, then they are considered as only one single taxable person. So branch is not considered as a different entity from the taxable person point of view. You can consolidate their books of accounts, and you're liable to pay tax and file the returns collectively for both of them. So branch is considered as a one and same taxable person. Going forward, what is the basis of corporate tax? So on what basis you need to tax your income? So for a resident person, as I told you that why this is important to differentiate between a resident and non-resident person, is because we need to see which are the income taxable in the hands of resident person, which are the income taxable in the hands of non-resident person. So in case of non-resident person, income from inside and outside UAE is taxable. So all the income they are earning, either it is from UAE or outside UAE, is going to be taxable in terms of resident, though the foreign tax credit will be available for the same, but at the first point the taxability is there. For non-resident person, income attributable to PE, permanent establishment, or sourced income from UAE is the only income which is going to be taxable in their hand. So permanent establishment, what is permanent establishment? We will see that in the upcoming slide. Any income which is generating from permanent establishment and sourced from the UAE, that is going to be taxable in the hands of non-resident person. Now let's come to the non-resident person point. What is the income sourced from UAE? So any income, in general layman language, any income which is generated from UAE is considered as a UAE income sourced from UAE. And here is a list. This is an inclusive list. This is the only kind of example they have given, that these can be the income which you can consider, which is considered as an income sourced from UAE. But this is an inclusive list. There are other kind of income also will be included in this list, which you think that it is sourced from UAE. So it's a kind of majorly income which is generating from UAE is UAE sourced income, which includes any income derived from a resident person. If any income is derived from a resident person from a UAE, it's considered as UAE sourced income. Any income derived from non-resident even, but accrued or received through a permanent establishment of a non-resident person, that PE should be UAE, then also it is considered as UAE sourced income. Income from sale of goods, sale of services, any interest income, insurance, reinsurance, income from the sale of shares and capital of a resident person, income from movable and immovable property in the state. So that is very important. Here they have mentioned this thing, that income from movable or immovable property in the state is also considered as a income sourced from UAE. So any sale of movable or immovable property, so if we are talking about immovable property, it covers the real estate also. So as a business, as a UAE registered company, if you are liable to pay corporate tax, then any transaction, any sale of assets, either it is movable or immovable, it is also a part of your income, any profit and loss you are incurring on that. So here there is no different concept of capital gain tax. It is going to be taxed at the same rate at 9%, but any income from movable and immovable property in UAE is going to be taxed under corporate tax. Then the second element of being a non-resident is a permanent establishment. So when it is considered that either if you are not registered in UAE, you can consider to be resident in UAE. That is, either you have a fixed place in UAE, or any person who is doing business on your behalf, then you are considered as having a permanent establishment in UAE and you are liable for corporate tax. So fixed place can be the branch, office, factory, workshop, any land or building. They have given an exemption list also, that only if there is storing of goods, there is only displaying of goods, then you are not considered as a permanent establishment. In this PPT, I'm just covering the basic level of information. For every slide, we can go more in the detail. This is only 10% information which I'm sharing just to give you the layout of what came out. But there are the exceptions and things are there which need to be go into the detail. So permanent establishment, first the fixed place. If you have any branch, office, factory, workshop, land and building in UAE, though you are not registered in UAE, you are considered as a resident, non-resident taxable person of UAE. And any person on your behalf, if doing business not in his personal or professional capacity, only dedicatedly for you, then it is also considered as permanent establishment. Let me give you example. For example, you are having any marketing agency services, and there is a consultant based in UAE, and you have a business outside UAE. For example, let's see India, and as an India company, you don't have any dedicated person here. You are, for the assignments you are having in UAE, you are taking help of a marketing agency, and they are doing their own business also, and they are taking care of your business also. So they are not you are not considered as a permanent establishment in UAE in that case. But if you have someone dedicatedly only for your business, who is taking the business on your behalf, taking the decisions, doing negotiations, finalizing contracts, then you are considered as having a permanent establishment, and the profit of the same business is going to be taxable under corporate tax. So this is about the non-resident. So as a non-resident, if you have a permanent establishment and you have UAE sourced income, that income is going to be taxing UAE. Now come up with the exemptions. In the last public documentation we have seen, they have come up with a few exemptions, which includes if you are involved in any extraction of natural resources business, any dividends. Here they have given the more clarity on that part. So the extraction of natural resources is already exempt, because they have the tax on Emirates level. Even they have clarified that if you have any income related to non-extractive of natural resources also, and they are taxable at the Emirates level, they have exemption on that income also. Other than those extractive natural resources income, here are the exemptions they have mentioned. Dividend or other profit distribution received from a participating interest in a foreign judicial person. If you have received any dividend or any profit distribution from a participating interest is, they have defined that if you have more than a dedicated percentage of interest in any foreign company and you are receiving dividend or any profit distribution from there, that is going to be exempt. Dividend and other profit distribution received from a judicial person, that is a resident person. Any local company is giving you discounts or any profit distribution, that is also exempt, because that is already taxable in their own hands. Income from foreign permanent establishment is also exempt, but there are some conditions. For example, you have a company in UAE and you have a foreign establishments also. So that income can be exempt. As a resident, the income outside UAE will also be taxable, but you can get the exemption of foreign permanent establishment income if the tax on that income you are paying in that income generating country is more than 9%. So if you are already paying more than 9% tax in that country, then you can claim the exemption. So this is the basic condition, but there are some other conditions in terms of compliance also you need to fulfill, then you can get the exemption on the foreign permanent establishments. Then income to a non-resident person operating from operating aircrafts, ships in international transportation. So if you are a non-resident person and you are having any income from operating any aircraft or ships in international transportation, they have given the exemption on the same also. Then investment manager, this is a very important exemption they have given. If you are an investment manager, your income is exempt. So here we need a little bit more clarity. So as an investment manager, they have mentioned as an investment manager definition that if you are engaged in the business of providing investment management or brokerage services, so you will be exempt. So we need a more clarity. Either as a real estate brokerage, you will be exempt from corporate tax, though from the decree law it seems that it will be exempt, but we need more clarity. We are expecting more clarity in the cabinet decision. The investment can be in the commodities, real estate, bonds, shares, derivatives, or any security or any other description. So if you are an investment manager of any kind of these investments, then your income as a manager, whatever income you are earning, that is liable for exemptions. Transaction of buying or selling of any foreign currency or placement of fund at interest is also exempt. So here we can see the exchange houses also we seem to be covered under the exemptions, but still we are for the final conclusion we are awaiting the cabinet decision on the same. Now let's come to the biggest exemption which we are awaiting is the free zone exemptions. So as I mentioned that free zone exemption, free zone income is exempt only for the qualifying income in qualifying free zone. I can see there is one hand raised by Mr. Logan Parwar. I think you can hold on the questions. You can just type also your questions on the Q&A. We will take the questions in the end. That will be maybe during the session itself. You can have more clarity on your questions, but we can take the questions in the end. We will try to take as much as questions we can take in the end. So here I'm explaining the qualifying free zone. If you are in the qualifying free zone and you are earning the qualifying income, then you are liable for a exemption. So what is a qualifying free zone? The condition for the same is if you are maintaining if the free zone have a adequate substance in the state, that is qualify for qualifying free zone. If you are derive qualifying income for qualifying free zone, then you are exempt from corporate tax. Some of the free zone have a fixed period like 30 years, 50 years, 100 years of tax exemption. If that exemption should be there, then only you are liable to get this tax incentive of 0% corporate tax. But then again, they have mentioned that period should not exceed the 50 years. So still there is a clarity required. As per me, the 50 years from the date of establishment of that free zone, but we are expecting more clarity in the cabinet decision that whether it will be from the date of incorporation of the company, which is hardly I will say they will go for. It should be from the date of the existence of the free zone. They can give the exemption of this limit of 50 years. Either they have committed that it will be 100 years of tax incentive, but it is not possible as per the corporate law. It is a 50 years exemption you can claim, but we need more clarity on the part that 50 years from the date of establishment of the free zone or date of the establishment of the company. But that tax incentive should be there. If any free zone don't have, then I doubt that will be qualify as a qualifying free zone, and income under that qualifying free zone will be exempt from corporate tax. Then again, one of the most important regulation which you need to qualify for to get the exemption is comply with the provision of arm's length principles and transfer pricing documents. This is a very important challenge. I think the whole UAE is going to face, because transfer pricing is itself a quite complicated regulation and compliance, and in the decree law itself, they have covered majorly transactions in the transfer pricing regulations, because here they will they mentioned that not even the international transactions, the domestic transactions will also cover under the transfer pricing regulation. So you need to maintain the documents and proof to prove the authority that you are doing the transactions at the arm's length price. That is very important in UAE. They are coming up with, even they have mentioned in the transactions, that whatever the transactions as a owner or a director or a manager of the company you are doing with the company, that also covers under the purview of transfer pricing. I think other than the very small businesses, all businesses need to comply with the transfer pricing regulations. That depends on the kind of transaction. So before going forward, you need to analyze that what are the kind of transactions are going to cover under the transfer pricing regulation, and how you are going to comply with them, or how you can reduce them, so that the compliance of transfer pricing will be less. So this is about the qualifying free zone. Any income under this only qualifying income under the qualifying free zone is eligible for exemption in the corporate tax. Then there are the non-deductible expenses. So the non-deductible expenses are fines, penalties, amount other than any compensation for damages or breach of contract. Any fine or penalty is not eligible for a deduction in your P&L account for computing the corporate tax income, your taxable income. Amount withdrawn by a natural person from their business. So this is, I think, the major doubts covered. Many people come up with this tax planning, that if they are going to have a corporate tax, then they can withdraw the salary. So they have given this non-deductible expenses, that if you are a natural person, you are doing business, so any amount you will withdraw as a drawing, as a salary, as a profit, as a dividend, it is not going to be deductible under in your profit and loss account while you're calculating your taxable income. So this tax planning will not work further. This is only regarding to the natural person. If you're a single owner, if you are a shareholder and there are 2 or more partners, then the regulations are different. You can transfer, you can give the salary and remuneration, but that should be as per the market price. And then they have mentioned that the transfer pricing regulations will be applicable on that. So that part is there. Furthermore, any corporate tax in UAE or outside UAE you have paid, any tax is not deductible expense. Dividend, profit distribution, or benefits of a similar nature paid to a owner of a taxable person, that means a shareholder of a company or manager of a company, owner of a company, is not going to be deducted from the taxable income. Any donations or gifts or grants you have made to the public benefit entity, which is not a qualifying public benefit entity, is not deductible expense. Any bribe or illicit payment is also not allowed as expense. Recoverable input VAT tax, which you are showing in your VAT returns, is also not deductible. Tax on income imposed on taxable person outside UAE. Whatever income you have paid outside UAE is also not deductible expense. Now this is about the allowability of non-deductible expenses. So they have specified only few expenses: interest expenses and entertainment expenses, where they have put the limit. Otherwise, they have not put any limit on the part of deduction. So interest expense will be allowed, but only up to 30% of the taxable person's accounting profit before EBITDA. So whatever your profit before EBITDA, earning before interest, tax, depreciation and amortization you have, 30% of that interest is only allowed as a deduction. If you have interest less than that, then that is fully deductible. If you have more, that is not allowed as a deductible, you can carry forward that interest for next 10 years, and you can use the deduction of those interest in the upcoming years. But the interest deduction is not allowed if that is if it is to any related party in form of dividend, profit distribution, redemption, repurchase, reduction, or return of share capital. So if any of these form you are doing with a related party, then they are not allowed as a expenditure. In the same way, they have a limit on allowability of entertainment expenses. So they have mentioned that entertainment expense is allowed only up to 50%. Whatever expense you have made for entertainment, that from that only 50% is allowed. So what is the entertainment expense? Any expenditure which is incurred for the purpose of receiving and entertaining the taxable person, customers, shareholders, suppliers, or any other business partner. So here the different part from VAT is, here they have not mentioned the employees. So I'm not sure whether they will cover that in the cabinet decision or not. But any entertainment expenses for the employees you have, if you are doing, I think that is allowable 100%, because they have not mentioned that is here. But if you are doing for your customer, your shareholder, any business partner, supplier, that is only 50% allowed. What is included in entertainment expenses is any meals, accommodation, transportation, any facilities or equipment used in connection with such entertainment, amusement, or recreation is considered as a entertainment expense. So only 50% of that is allowed. Then let's come to the tax losses. So we talked about what will be the implication of corporate tax on the profits. There will be the 9% taxability or 0% taxability, or which expenses are deductible, what is the limit on the expenses. So here they have clarified on the tax losses also. Tax losses of any year, 1 year, can be adjusted in the subsequent period up to the 75% of the taxable income of that taxable period. So only 75% of your tax losses is adjusted in the same year. On 25, either you have any the tax loss amount is as much, but if you have a profit in any year, 25% you have to pay tax on the same. Either you have more tax loss of that income of that year. So what are the conditions to claim for the tax losses? Is both the taxable person are judicial persons. The direct or indirect common ownership of at least 75% is required. So here the tax loss adjustment is between two group companies. It's not with the individual level. It's between the two companies. Also, if in a group, if there is a common ownership of 75%, then you can adjust your losses. Even you are not registered as a group, you can do that. But the limit is you can do only up to the 75% of the income. So if the profit making company has to pay 25% on the corporate tax on the 25% of your income. Then the next condition is none of the person is a qualifying free zone person. They should be they are not getting any exemption from the corporate tax. Both are the taxable person and resident person. Non-resident person cannot adjust. Non-resident and resident person cannot adjust their tax losses even though they are a part of a same group. None of the person is exempt, which we have as an investment manager or as they are involved in any extraction of natural business. If they are not covered, they should not covered in any exempt person definition. And they should have a same financial year and following the same accounting principle for the preparation of their financial statement. If those conditions are satisfied, even though they are not registered as a tax group, they can adjust their losses with each other on the condition of 75% of the taxable income of that tax period. This is about tax losses. Then they have, as we are talking about the group, they have come up with the tax group concept also in corporate tax. Likewise, they have in VAT. So, who can be a part of a tax group? The 95% common ownership or voting right is there to form a tax group. Resident person should be a judicial person. Non-resident person cannot be a part of a tax group. Even a natural person cannot be a part of a tax group. They have a licensed person. Judicial person should be there to form a tax group. Neither of a parent company nor a subsidiary company should be an exempt person. All should be a taxable person. Then again, they are not for a qualifying free zone person is not allowed to be a part of a tax group. If you have a company in mainland, one company in free zone company is getting the exemption under being a qualifying free zone person, and you want to form a tax group with your mainland company and free zone person, that is not possible in corporate tax. That is possible only in VAT. Having the same financial year and follow the same accounting standards for preparation of financial statement is also one of the condition to form a tax group. Now, the last but not the least, these concepts are withholding tax and foreign tax credit. They have mentioned. We need more clarity on that. So, withholding tax is in layman language. If I will let you, withholding tax is a tax which it's a kind of tax deducted at source. If you guys are aware about the Indian taxation, so it is a tax which is deducted by the person who is deriving the income. So it is a tax which is deducted from the source of the income. So if you are giving any providing or derives any income to the person who is outside UAE and the source is in UAE, so the liability to deduct the tax of that person lies with the person who is deriving the income, who is in UAE. So the UAE sourced income to a non-resident, which is not related to the permanent establishment, is covered under the withholding tax. We are awaiting if they need more other incomes under the withholding tax, then they will be classifying cabinet decision. But there is only now one income they have covered under the withholding tax, and the rate also they have given is 0%. But at the same time, they have given the authority that they can increase the rate on the basis of different type of incomes also. So maybe if not initially, but at the later stage, they can come up with different rates of withholding tax. As people who are dealing with KSA, Saudi, they know that for they have the withholding tax rates from 5 to 30% for different type of incomes. But currently here it is only 0%. Then they have cleared the concept of foreign tax credit also. So any tax you have paid outside UAE on the income on which the UAE corporate tax is also payable, that is considered as a foreign tax credit. And foreign tax credit is available only is not available more than the tax payable in UAE. So only 9% foreign tax credit you can claim if you have paid more tax. For example, in India it's 25%. You have paid 25% tax in India, then you cannot claim 25% tax here. You can claim here only 9% tax on that income, and the other foreign tax credit is foregone. You cannot carry forward also for the same, because here you are liable only for 9% corporate tax. So this is about the foreign tax credit. We have covered the specific areas which we think gives you the basic understanding of whatever is in this law, but still there are many gray areas, as I mentioned initially also, that we need to wait for a cabinet decision to get more clarity. But it's a basic idea and layout they have given, that how you need to plan. So I have few advices on the part of you need to prepare yourself, your business for the corporate tax. At least keep your books of accounts and everything in place. Start with auditing. In the cabinet decision, in the consultation document, they have come up with that audit is going to compulsory for major companies. But in law, we can see audit is not compulsory for all the companies. But at least if you start with audit, you get to know about that how much your books of accounts is efficient to cope up with the this upcoming corporate tax law. This is going to be 9% straightforward on your income. If you want to reduce your bottom line, then you need to plan for the same, and first you need to have all the things in place. So first of all, you need to at least go for 1 or 2 year audit. From 2022 you will start, then 2023 you will tune up, and when actual liability in 2024 is going to cover as per the regulations, that it is going to be coming from 1st June 2023. But if you are following the calendar year, that for you it is going to be applicable from 1st January 2024. So your first taxable year will be 1st January 2024 to 31st December 2024, and you have enough time to prepare. But you need to be prepared, because this is not a like VAT 5% only, and then again it is not the burden on the business, it is actually burden on the consumer when it comes to VAT. When it comes to the corporate tax, it is a direct hit to the businesses, and they have clarified that there will not be any reduction in any licensing fees or any other government fees, because according to the government, that is already a compensated one. So 9% is going to be anyhow cost to the business. So as a financial professional or a finance manager, heading of finance department, you need to see that how to reduce that cost to the business, because that is a direct cost. You need to identify the transactions which covers under the transfer pricing regulations, map all those transactions, try to identify how you avoid that, because transfer pricing itself is a quite complicated compliance, I will say. You need to prepare a lot for the same, and if either you are covering, at least you can map first that what are the transactions going to cover for transfer pricing, and then you can plan your things accordingly. So we are awaiting the cabinet decision and other procedural law on this, and still there are many gray areas which we are expecting to be clarified in the clarifications. As we can see now, on the VAT it's going to be 5 years, and we have more than 50 clarifications on the VAT. So authority is quite supportive in that way, but the basic preparation should be there. So this is only from my side in terms of presentation. Now we can take questions, I think, Shyamji.
Thank you, Bivar, for a nice input about the upcoming corporate tax. Now, Mr. Arfad is asking that is there a specific time frame to file the corporate tax return to be done? It can be done quarterly, semi-annually, or etc. What?
It will be annually. They have mentioned that in consultation document itself, though they will clarify in the tax procedure also. It will be annually, and it will be within 9 months from the end of the financial year. So if your financial year is 1st January to December 2024, then your first return will be due before September 2025. So it will be annually.
And if it is from June to...
It will be, if it is from June 2023, then you will be liable to have your first return after April 2024. So whatever the financial year following, after that 9 months, within 9 months, you have to file the return and pay the tax.
Thank you. He's asking again, free zones are exempted from it? And is there any threshold for instance minimum or maximum?
So for free zone, as I mentioned, that the qualifying free zone and qualifying income clarity we are expecting from the government side, that what is going to be the qualifying income. So we cannot say upfrontly that 100% free zone income is going to be exempt. But though it is going to be 0%, you need to file the return. That is clarified in decree law. So you have to file the returns, you have to prepare the things. Maybe you don't have to pay 9%, but the filing will be there.
It is considered as a 0% rather than exempt.
Yeah.
Okay. Now, who are exempted from corporate tax?
So as I mentioned in the slide itself, that the exemption is for the dividend incomes, which is dividend income locally, foreign establishments. If you have a permanent foreign establishment and they already paid tax more than 9%, those are exempt. If you are into the extractive of natural resource business, those are exempt. As an investment manager, you are exempt from the corporate tax, but there are the conditions in that. As an investment manager, fund manager, how you are exempt. Yeah, you get the exempt.
Okay. Now, Mr. Walker is asking that property income by an individual person is not taxable. If we want to know, is it taxable or no?
So this is like if you have only one or two property as an investment of a natural person, that is not going to be the taxable. But if you are into the business of the same, you are owing 10, 12 properties, you are having only rent income, that is your kind of business activity, and you need the license for the same, then you are covering under the corporate tax. But as an individual, you are a salaried person, you having one or two property earning rent income, you are not covered under the corporate tax.
So if it's under a personal name, there are high chances that this properties will, the income from the property will be exempt. But if you have a license for it and the properties are under that license, you're receiving the rent or even any gain or loss from the selling or buying of a property, then yes, it will be covered under the corporate tax. But under the personal name, chances are high that it will be exempt.
Okay. And another participant asking that mainland company doing 100% export, will they be taxable?
So if mainland company is doing export, that majorly on the basis of information we can say is going to cover under the corporate tax. Because being a free zone company, if you are only dealing with outside UAE, then the exemption chances are more as per the consultation document. But being a mainland company, either you are doing local sale or export, you are covered under corporate tax.
And in the free zone also need to understand the qualifying free zone.
Yeah.
Like to select for a qualifying free zone specifically, which have already declared a tax exemption for 50 years.
Thank you. Great. So Mr. Parmar is asking that if it investment manager, can you say that if individual or investment firm as well? When you talk about investment manager, do you mean individual or firm or investment firm all or how?
So fund manager is the one who is doing, who is managing the portfolio for many clients. It's not as a individually you are doing investments and you're covering as a you're covered under this investment firm more. I will say that I'm talking about the exemption is there because they have mentioned that either you are doing investment managing investments in terms of shares, commodities, real estate. So I will say the investment firm will get the exemption.
Okay. Then there's a question that
what the is income of those firms are exempt.
Then there's another question that what is the carry forward limit in terms of number of years?
So what carry forward? What do you need to carry forward? The interest expenses you are carrying forward or tax losses? Then I think if you're talking about the interest, then the 10 years are there.
Okay.
So, like if there is a limit that only 30% of the profit before EBITDA, 30% of that only you can take as an interest expense. So if your interest expense is more, then you can carry forward that interest up to 10 years to get the exemption.
Great. Now, applicability of that, I think you already answered. Now, Mr. Sandeep is asking that corporate tax implications on out of scope sale, third point shipment. Can you please explain?
So see, out of scope sale is not anywhere defined in corporate tax. Out of scope is defined in VAT. So as per corporate tax law, there is no transaction which is out of the scope. If you are talking about third port shipment, generally in layman language, what we understand from third port shipment is that people are billing from here. Goods are coming from one country and going to another country. They are not touching the land of UAE. Then it depends where your company is. Is your company in mainland? Is your company in free zone? So again, if I'm talking about the mainland, it is very hard to get the exemption if your company is in mainland. But if your company is free zone, then there are the more than 90% chances that on third port shipment you will get the exemption because you are dealing outside UAE. but still we need a clarity on that part also. So you need to check. But mainland, there are very less chance that you will get the exemption on mainland companies.
Great. Mr. Iqbal is asking that free zone income means what? Like he want to have a clarification for the same. What exactly you mean by free zone income?
Yeah, so that clarification even we also want to know. There is no clarity on the qualifying income. So they have come up with a qualifying free zone concept. Under that qualifying free zone, qualifying income should be there. They have defined what is a qualifying free zone, but they have not defined what is qualifying income. So this is our expectation. Maybe the qualifying income is the income which you are earning from the transaction outside the scope, outside the UAE or within the free zone. But they have not defined that yet.
Okay. Is there again, Mr. Mandar is asking that, is there a list of qualifying free zones exempted from corporate tax in the UAE?
No.
Like
they have not come up with any list. Okay. They have only given the conditions which I explained in the presentation, that there has to be substance of the free zone, there has to be a qualifying income from the qualifying free zone, there has to be a tax incentive itself from the free zone, that that free zone is able to give the tax incentive in their original establishments, and that again for the 50 years. And then again you need to comply from transfer pricing regulation. So if all these conditions are following, then the qualifying free zone you are, but the list is not there.
So it's specifically currently to resolve that thing immediately, I would say you need to check the free zone where you are registered, because that clarity free zone authority will give as of now, in case the list is not been declared by the FTA.
Now, another participant asking that, is income from out of the scope income, goods and services from outside UAE exempt?
Yeah, if you're doing, can you just come up with questions once again?
The question is writing that income from outside, out of scope income, okay, is it exempted from corporate tax?
Yeah,
like
so
I guess it's
yeah, I think it's the same question. That so there is no concept of out of the scope in the corporate tax itself. So if it is only third port shipment, someone asked me, so that is that depends. Your company is in free zone or mainland, and that we are saying on our this thing, there is no clarity on that part. So the concept of out of the scope income is not there. There is no out of scope income in corporate tax. Everything is in scope income.
So these are the major questions the team has asked. And one more question, not the least, tax implications for capital gain. Somebody is asking to explain it.
Yeah, so capital, there is no defined capital gain tax in this corporate tax, though they have covered that if there is any profit on the transfer of movable or immovable property, that is covered under corporate tax. So as a business, if there is any sale of asset or any property as a land building or something, then that is going to be covered under your profit, your P&L account. Actual profit, not the realized or unrealized in terms of depreciation and amortization we are talking about. Actual profit is going to be covered as a 9% corporate tax.
Thank you. So I guess we have answered, she has answered almost all the questions, whatever has been put in the chat box. And great for all the participants that you have shown so much interest. I think there's more questions are there.
What I suggest is maybe you can have this email address is also there, and I'm sure you have Delphi contact details are also there. You can drop your questions in this email address. We can revert back to you, because I can see lots of questions are there which is we are not able to give answers of all the questions, and you can explain the full scenario so that we are also comfortable to give you answers accordingly.
Definitely. Thank you. And thank you, Biva. Thank you, Pranab, for such a wonderful webinar. And
thank you.
Thank you everyone for attending us, and we will keep update you on the further developments on the same. Your higher participation also encourage us to do this frequently, and thank you, Shyamji, for collaborating on this part.
Yes. And every webinar, every month you are carrying out the webinar and just coming up with the latest information about the income tax. And just to a short summary to all the participants who have joined the webinar, that BIVA have already completed one batch for the taxation, and again we have come up with a unique services for the batch that if not that batch has been finished, we have kept few hours for the unfinished for them, that we'll keep on updating about the new topics, whatever has been trained them. And new batch also we are going to start shortly for the corporate tax and transfer pricing. So any attendee who are interested for the batch, they can always get back to us, okay, with all the details. Our team will contact them. Thank you Biva, and thank you Pranav for such a wonderful webinar and so much insight about the corporate tax in UAE. Thank you.
Thank you sir. Thank you everyone.
And thanks to all participants. Have a patience and be with us till last. Okay, normally we don't find out that people are with us for almost 1.5 hours or 1 hour. Okay, and the participants are consistently with us from beginning to end. Thank you.
Thank you, sir.
Thank you.
Thank you.